Beneath the surface of the Caribbean, ancient coral structures form the foundation of a highly complex coastal ecosystem. But when a Category 4 hurricane tears through the region, the violence of the storm surge can shatter those living structures, scattering them into thousands of pieces on the ocean floor. The reef can actually be saved. If local divers can manually reattach the living coral fragments to a solid base within a strict biological window of just a few days, the coral survives. Miss that window, and it bleaches and dies. Hitting that 72-hour deadline requires immediate logistical mobilization. You have to hire boats, buy fuel, and pay specialized labor right away, which means you need massive amounts of emergency cash on hand. Biological survival in this scenario comes down entirely to financial liquidity. Without instant capital, the ecosystem cannot be rescued. That urgent timeline exposes the core problem with traditional indemnity insurance. The indemnity model is designed to make a policyholder whole, but only after you prove a physical loss has actually occurred. You can see on this timeline how that traditional process plays out. After a disaster, you have to organize post-event surveys, wait for claims adjusters to deploy, and usually engage in months of bureaucratic haggling over the assessed value of the damage before a check is finally cut. Now look at the biological reality below it. The coral fragments have a survival window measured in days. The insurance industry's demand for perfect precision is fatal to the reef. By the time an indemnity check clears the bank, the coral is entirely dead. In 2026, a pilot program by Willis and the Caribbean Biodiversity Fund tested a different approach. They insured roughly 1,800 square kilometers of reef across 4 Caribbean states, including the Dominican Republic and Jamaica. They used a financial mechanism called parametric insurance. Instead of insuring the physical coral itself, the policy is tied directly to a data index. This map shows the contract's strict rule stack. It draws a geographical boundary and measures a storm parameter, like sustained wind speed, inside that box. When a storm crosses into that area, if the wind speed metric climbs to the threshold, the policy triggers automatically. By tying the contract to an observable weather parameter rather than actual physical damage, the system completely bypasses the need for human claims adjusters or post-storm surveys. The financial reaction happens the exact second the mathematical threshold is crossed. The contract immediately authorizes a release of up to $150,000 per event, drawing from a $1 million program limit for the hurricane season. That instantaneous liquidity flows directly to local response teams. They can mobilize boats and deploy divers while the storm clouds are still clearing the horizon. In this system, the raw measure literally becomes the market. Abstract environmental data converts instantly into contractual emergency cash. Sobering. But this system carries a critical vulnerability known as basis risk. This is the scenario where abstract data fails to match the physical reality on the ground. Look at the contract map. Imagine a hurricane's eye tracks millimeters outside the designated GPS box. Wind speeds inside the boundary never reach the trigger threshold. Even without triggering the rule, an expanding storm surge from that nearby system completely devastates the physical reef. Because the strict rule of the contract wasn't met, the financial payout is precisely zero. The reef is destroyed and no emergency capital arrives. Stakeholders accept this catastrophic gap by design, prioritizing the immediate release of capital over the perfect precision of a physical survey. They are consciously trading perfect surveyed precision for the ultimate necessity of speed. This same dynamic applies well beyond the reef. Whether it's Canada's new Natural Capital Taskforce or the indicators governing $31 billion in sustainability-linked palm oil loans, nature finance operates through these specific rule systems. Environmental information, like a forest's carbon stock or a borrower's deforestation rate, acquires financial consequence only when an institution attaches a rule to it. These rules decide what finance recognizes, prices, and pays for. For practitioners, the goal is to look past the label of the financial product and map the underlying rule stack, testing whether those specific indicators capture the material impacts that matter when disaster strikes.